To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
Today we are going to start the next part of this chapter, which is about valuation of bonds and debentures. So far we have talked about equity share valuation, we have seen your right share valuation, we have seen preference share valuation. Now comes the next part, which is valuation of bonds and debentures. As part of this, we'll have convertible debentures and all of that, and then we'll have warrants, CPs, commercial paper, certificates of deposit, repo rate. All of that is next part. But now we are going to concentrate on valuation of bonds and debentures. And believe me, valuation of bonds and debentures forms the base for these other valuations, whatever I refer to, that is CP, commercial paper, repo rate, and all of that stuff, right? So now we are going to concentrate on valuation of bonds and debentures. Before we get into actually the depth of valuation of bonds or debentures, can we first understand what is a bond, what is a debenture, or first of all, what is difference between a bond and debenture? If you honestly ask me, right, it is a very, very confused or rather very muddled story, very muddy story. So what is this difference between bond and debenture? In US, bonds are secured instruments, debentures are unsecured. In UK, it is ulta. Debentures are secured, bonds are unsecured. So in India also, we actually use corporate bonds, we use the word government bonds, we use corporate debentures. So actually, if you honestly ask me, right, everything is muddled and confused. So the easiest way to understand a bond or a debenture is it is a fixed income security. Fixed income security, that is, usually there is a fixed income arising out of it. It is basically similar to a borrowing and a financial security issued by the borrower to the lender. So let's say there is a borrower called company A. Company A is borrowing, let's say, from a lot of people in the market, right? So the company A will issue a financial security called as a debenture or a bond. For a moment, let us use the terms interchangeably, bond or debenture. They issue them to the public. Public subscribes to the bonds or debentures just like they subscribe to equity shares, and then they give the money to the company. So the money comes from the bond holders or debenture holders to the company, and the company uses that particular money for whatever purpose it intends to, let's say working capital or long-term project or any specific purpose that it indicated in the terms of the issue of this bond or debenture. Company keeps paying interest to these subscribers of this particular issue on a periodic basis. It can be monthly, it can be quarterly, it can be half yearly, it can be annually. Typically, it is more often than not, it is half yearly or annually. Sometimes you may see quarterly also. Very, very rare cases it could be monthly, but whenever a financial security is issued, usually it is semi-annual or annual, right? And at the end of the period, this particular company will actually repay the entire loan, and then these debentures are cancelled. Debentures or bonds are cancelled, correct? This is the normal understanding of what a debenture or a bond is. Now, for every aspect that we discuss, right, there can be a variation. What do I mean by that? Let us say the company has borrowed money from these people. Okay, it has borrowed money. I said it can make interest payments, right? We said interest payments can be monthly, we said interest payments can be quarterly, half yearly or annual, correct? So there are variations in interest rate. Is the interest rate fixed? In most of the cases that we would have heard of, interest rate will usually be fixed, but there are also floating rate bonds. Okay, so interest rate can vary. Then capital repayment, right? You would have all heard of this debenture issuance and debenture redemption at discount, at premium, all of that. So debentures or bonds can be issued or redeemed at premium or discount, correct? Then the bonds can, instead of making repayment, they can be converted to equity also. There is another variation. Then the interest payments itself are not made. That is, the company issues a bond, okay, and no interest payments are made, but at the end of the period, money will be repaid to the investors. That is, initially the company will borrow 100 rupees, okay, it will not make any interest payments. After 3 years, the company will pay back 150 rupees. Okay, no interest payments are made. Okay, that is one variety. Then the company will have a right to say, I will repay at any point of time. Okay, that is one variety. The investor will have a right to say, I will want my money back at certain point of time. That is another. So bonds or debentures can be structured in multiple ways. Bonds or debentures can be structured in multiple ways. Why is that? Because there are 4 or 5 variables. What are the variables? One is the interest rate which is paid. Okay, one is the periodicity based on which the interest is repaid. One is the total time for the borrowing, correct? Then total amount of borrowing. So there are about 4 or 5 factors which are available, and each of the factors can be varied, right? We will see all of that, but I'm just trying to give you an understanding of what is a bond or a debenture and how is the transaction usually structured, right? Now let us actually take a step back when we are going to discuss about bond and debenture, and I will take you through an example of a normal fixed deposit. Okay, because that will actually help you understand what is this entire whole bond or debenture, how is it structured, how is it priced, and all of that. Okay, let us take that example, then we will go into other terms. Okay, there are technical words for each of the things that we discuss. What is the time duration, what is the interest rate, what is the payment frequency. For each of them there is a specific technical term. We will get to that, but before that let us first understand something about a normal fixed deposit that you would put in a bank. Okay, once you understand that, I will actually be able to relate a lot of these things so that you can understand it very, very easily. So friends, let us say your name is Ram. Okay, your name is Ram. You have some money. Okay, you have some money, let us say 10 lakhs, right? This 10 lakhs you go and put it in bank, State Bank of India. You have gone and deposited that money in State Bank of India for a 5-year deposit, fixed deposit. Now when you put that money in State Bank of India for a 5-year deposit, you put 10 lakhs, correct? Then when you fill the application form, or nowadays it is all online. So when you online, they will ask you a bunch of questions. How long do you want to put the deposit? That is called maturity. Maturity, or it is called as term, deposit term or deposit maturity. That is what they will ask you. You will say 5 years. Okay. The first word what we have learned is term or maturity, which is 5 years. Second, interest rate. Usually the banks say we have this interest rate for 5 years. Okay. You don't have a choice. I mean, you don't have a choice whether you want 6% or 7% or 8%. Okay, for a 10 lakh amount, they will say, boss, I will give you 5%. Currently, we are for all 10 lakhs amount for 5 years of maturity, we are giving you 5% return. So you actually have to accept that. But let us say I go to SBI with 1000 crores. Then I will say I have some leverage. I will say, dear SBI, I am putting 1000 crores for 5 years. Please let us negotiate interest rates. In the market, that rate is this much. I want slightly higher, 5.5, 5.6. You will negotiate. Okay, at that point of time, you will have negotiation capability. But as a small retail depositor, when you are putting 10 lakhs into SBI, you don't have any negotiation power. They will inform you what is the interest rate that they are willing to give on this particular term deposit or a fixed deposit. Okay, term or fixed, both are same. Okay, term deposit or fixed deposit, both are same. So they will say, we are willing to offer you 5% on this 10 lakhs where, you put this deposit with us for a period of 5 years. Okay, agreed, very good. Then they will also say that, the interest repayment frequency, periodicity of interest, right? Interest frequency, it is called interest rate payment frequency. They will say, we will give you monthly. They can give you quarterly also, they can give you half yearly also, they can give you annually also, and they will also ask you an option whether it is cumulative or monthly payout. That is, they will say if you want the interest, we will actually give it to you in your SB account what you have, or we will add that to the deposit and make it a part of the deposit. Okay, you have to select that particular option. You will select that, whatever. Let us say for argument's sake, you say, no, I want monthly payout. Every month they will compute and pay it to you. Okay. Now, when they are giving you interest, they are depositing it in your SB account. There will be TDS, VDS implications. Let us not get into that. That is part of your income tax subject. So, please don't discuss that here. Assume that entire money is coming back to you. Entire interest, whatever they are paying, it gets credited to your SB account. Okay. So far, so clear. Very good. Now, here I am going to start introducing some twists. I am starting to introduce some twists. Okay. And then I will link this entire fixed deposit that Ram has with State Bank of India with entire bonds and debentures. Okay. What are these twists that I am trying to introduce here? See, when you were depositing with the SBI, you said, SBI said 5%, you accepted it is 5%. Okay. And let us say this fixed deposit is only in your name. Okay. Fixed deposit is in your name. Now, tomorrow, let's say SBI, when they gave you that 5%, they had some working at the back of their mind. They'll have big workings, how much they can offer and all of that, correct? They would have benchmarked it to some rate. Let us say RBI rates are hovering around, let's say 3%, 4%, something. They would say, they'll put a benchmark, given that RBI rates are here or my cost of funds is this, I will want to offer you 5%, correct? Now, let us say suddenly after 1 year, 1 year is gone. Your total tenure is 5 years. It's called either tenure or maturity or whatever, right? That is 5 years. 1 year has passed. Suddenly, in the entire country, interest rates have gone up. Interest rates have dramatically gone up. Interest rates have dramatically gone up. What was 4% of government RBI's rate is now become 8%. SBI's cost of fund, which was 3%, 4%, 5%, something thereabouts, right, has suddenly become 9%. So, if you were to put a deposit after 1 year, initially you put for 5 years. After 1 year, now if you put the same deposit for, let us say, 4 years only, okay, let's say the balance 4 years period, same SBI says, was last year we were giving 5%, now interest rates have gone up in the market, now we are willing to offer 10%. SBI says, boss, I am willing to give you 10%, please put another 10 lakhs for 4 years, for 4 years itself we will give you 10% interest rate. That is brilliant, right? So, you will decide whether to put or not, that's a different thing. Whether to place an FD in after 1 year, you will take a decision if you have money. For a moment, assume you don't have money. Okay, for a moment, assume you don't have money. Okay, now this initial term deposit that you placed with SBI, do you have an option to cancel it? Most of the times in case of fixed deposits, you can do something called premature closure. That is, before the maturity date, you can actually close the deposit. Okay, before the maturity date, you can close. When you say close, what it means is, I don't want this entire 5 years, I want only for 1 year. So, is what SBI will do, instead of giving you that 5 years interest rate, which was 5% at that point, they will give you only 1 year interest rate. 1 year interest rate, let us say, is 4%. So, for 1 year, they will give you 4%, and they will also levy some penalty for actually cancelling the fixed deposit, and they will give you your money back. Correct? They will give you your money back. All this actually happens in real life, by the way. I am not making up any stories, this all happens. Right? Now, that is one scenario. Now, let us say, in our case, SBI says you cannot cancel. SBI says you cannot cancel the deposit. You have given it to me, that's all. You cannot take it back. Let us assume SBI has the right to say they will not cancel the deposit. They will not give you your money back. Okay. You understood this point also. This is the second twist. What was the first twist? First twist was interest rate has gone up from 5% to 10%. Second twist is that SBI is saying, I will not allow you premature withdrawal or premature closure or pre-closure, whatever you want to call it, of the deposit. Okay, that is the second twist. Now, let us come to the third twist. You, Ram, you suddenly require money. Urgently, you're constructing a house, you urgently want money. Correct? Now, you don't have any other money. Only money that you have is this fixed deposit. Okay? Only money that you have is this fixed deposit. Based on the fixed deposit, you can take a loan. That is one process that is available. Keep that aside for a moment. There are people who take the fixed deposit and give loans based on that. That is independent. Okay. Let us say, you say, no, boss, I want to sell off this fixed deposit. I know what I'm saying is, usually you don't hear terms like selling deposits at all. Argument's sake, you say, I want to sell this fixed deposit to somebody. Now, this is a deposit of 10 lakhs on which, let us say, you are getting monthly payment. That is what we discussed, right? Monthly payment of 5%. Okay, monthly payment of 5%. Okay. And so, next, what are the cash flows for this particular deposit? You will get every month 5% into 10 lakhs by 12. Why 12? Because into 1 by 12. Correct? So, for next 4 years, because already 1 year is over, next 4 years, every month you will be getting 4,166. At the end of the period, you will be getting 10 lakhs. Correct? Now you are saying, I have this stream of cash flows. What do I have? I have this entire stream of cash flows which I want to sell to somebody. When I say selling a fixed deposit, this is what I mean. So you will say, Ram, instead of Ram receiving this money, let us say some Shyam. Okay, you are selling this fixed deposit to Shyam, and Shyam will receive all this money. Okay, I am selling this fixed deposit. So basically I am selling the entire stream of cash flows, and Shyam will now pay me some money for this entire fixed deposit. Shyam will now pay me money for his entire fixed deposit. So now SBI is gone, no longer there in the story. SBI is paying interest, but then now a new party has come called Shyam. Shyam is paying you some money on first day of year 2, because 1 year is already elapsed. So year 2 has begun. On first day of year 2, Shyam is paying a lump sum money. So that what you are saying is all this stream of cash flows what you are getting from SBI are now assigned to Shyam. Okay, understood the story? So far so good? You understood the story? Now, today the 4-year interest rate that SBI is willing to offer, if you put a fixed deposit, remember we discussed 4-year interest rate is 10%. So for Shyam, who is lending you the money, who is giving you the money, he is giving you X amount. I don't know what that X amount is. Okay. That X amount what he is giving you, alternatively, he can deposit the same money with SBI and earn 10%. correct? So 10% at minimum is his opportunity cost, correct? 10% is Shyam's opportunity cost. So what Shyam will say is, boss, how much money I have to give you? Okay, let me compute the money. I have all this stream of cash flows, 4,166 that you are getting every month. Shyam will say, this is the stream of cash flows I am getting. In return, I am going to pay you an amount called X. How will I compute this X? I will discount all these cash flows by 10% because the opportunity cost of this X for me is depositing it with SBI where I get 10% return. Got the point? So, Shyam will say, I will discount all these cash flows by 10%. Shyam will say, I will discount all these cash flows by 10%. Initially, even though you place the fixed deposit of 10 lakhs, after 1 year, interest rates have suddenly changed in the market. When you put the deposit, interest rate was 5%. Now suddenly the market interest rate has gone up to 10%. Shyam is saying that 10% is his benchmark. So when you are selling him the fixed deposit, Shyam says that I will, give you a lump sum money of X in return for this stream of cash flows, and that X I will compute by discounting all these cash flows by 10%. I will compute this by discounting all these cash flows, including the last payment after the 4th year. We are in beginning of year 2, right? So 2, 3, 4, 5. So 4 years are there, right? So at the end of the 4th year or the 5th year from original date, I will pay you, I will also get that initial 10 lakhs, but all of these cash flows I will discount it by 10% and you will compute a number. I don't know what that number is. Let that number for argument's sake is, let us say, some 8 lakhs. For argument's sake, let us take that number is 8 lakhs. Okay, I don't know exactly what that number is. Now, you had initially put 10 lakhs in FD. You were getting 5%. If you had kept quiet, every month you would have gotten 5%. But suddenly the market interest rate has changed. Okay, market interest rate has gone up. So you have a stream of cash flows. Right, which is being computed at a very low value where you are getting a return of only 5%, whereas market return is 10%. So you have an asset. Fixed deposit is your asset. For a bank, it is a liability. Please note, for a bank, when you put a fixed deposit in a bank, for bank it is a liability, for you it is an asset. So you have an asset that is giving you lower return, whereas market return is high. Agreed? So how will such kind of an asset be valued? Such kind of an asset will be valued at lower than its face value. What is its face value? Its face value was 10 lakh. Why did I say that Shyam will give you? Shyam will give you only 8 lakhs. Is the face value not, compare the 10 lakhs versus 8 lakhs. Is the value of 8 lakhs less than 10 lakhs? Yes, it is lower than face value. That is precisely the point. So when interest rates have changed, the discounting of the cash flows, you keep on discounting them with the new rate, which is a higher rate. And when such discounting happens, the face value, or rather the value of that particular fixed deposit in this case has come below face value. Oh, so it is come below par. So if you understand this entire concept, right, what I'm trying to explain in fixed deposit, that is, there is a stream of cash flows because the interest rates have changed, you urgently needed money, you sold the fixed deposit to somebody, that person is now, Shyam is willing to pay you only a lesser amount. Why? Because his opportunity cost of capital is only 10%. If you have understood this concept, believe me, you have understood 50 to 60% of entire chapter. The entire chapter is only about this. What is it about? Here, when we are talking about these payments, which are, where every month you get this 5% on 10 lakhs, which is roughly about 4,166 or something, some number like that, right? That payments are called coupon payments, and the coupon rate, the interest rate is called coupon rate. Coupon rate is 5%. Coupon frequency, that is, how many times is it paid in a year? It is paid, frequency is monthly, so it is paid 12 times. Frequency is 12, right? And the market interest rate is now 10%, whereas the coupon is 5%. So the interest rate has increased, the value of fixed deposit has come down. Same way in a bond or a debenture, when market interest rates increased and the coupon is a fixed number, your price of your bond will come down. And exactly ulta will happen when market interest rates are lower than coupon rates. If coupon rate is 5% and market interest rate is 2%, the value of your bond will increase. Why will it increase? You have same stream of cash flows, you are discounting them by a lower rate, so you will get higher present value, and you sum up all those present value, you will get a value which is higher than your initial face value. Okay, this is the broad concept I want you to understand. Now let us go into deeper aspects, or rather I won't say fully deeper, let us go in 2 steps deeper beyond what we have understood. If you have understood, as I said, right, if you have understood this particular example of fixed deposit and cash flows and all of that, you have understood half of this chapter. Okay, fair enough. Now let us move to the next part. So friends, now as I said, let us go two steps deeper. We have understood the fixed deposit example. Now let us take a very similar example in case of a company. There is a company, it is issued a bond or debenture. I said both of them are interchangeable for our understanding. We'll assume unsecured, secured, forget all those differences. Those all will come later. For a moment, assume they have issued a financial security or a fixed income instrument where income is coming fixed to the subscriber. They have issued a bond. Now this bond, it has something called as par value. Par value means just like what we have face value for a share, for a bond it's called par value, that is the value which is repaid or which is stated on the face of the document, right? So debenture certificate, share certificate, all of them, they used to be physical documents earlier. Nowadays they are all electronic. Nobody has all of them physical unless they are if they are small companies. Okay, so assume for a moment there is a physical document, there is a physical certificate, debenture certificate or whatever. That has something called as value which will be repaid at the time of redemption. That value is called par value. The company has issued debentures of, let us say, let us take only one debenture because will makes calculation simple. Let's take only one debenture of 100 rupees. Okay, this 100 rupees is issued and the interest rate, let us say, is 10%. At the time of issue itself, it is 10%. The market interest rate is also 10%. For that particular company, if it had to borrow from a bank, it would be 10%. So it is issued some debentures to some debenture holders, and they have subscribed to this company's debenture issue or bond issue, whatever you want to call it, and they are getting paid 10% per annum. Now in this case, the coupon is called 10%. Coupon is 10%, and the frequency, let us say, is annual. So interest is paid only once. Correct? And once a year, and let us say this particular bond or debenture is for 1 year. So they have initially borrowed 100 rupees. At the end of the year, they will pay back 100 and the interest of 10% on 100, which works to another 10 rupees. So they will pay back 110. Very simple structure. Very simple structure. Frequency is 1, coupon is 10%, par value is 100, issue price is also 100. Issue price means the price at which that particular debenture was issued and the money came to them. Issue price is also 100. Now we will change the same example and say suddenly that the market interest rate, so for this company now to borrow, or for this set of debenture holders to lend to this company of this type or this kind or this style, the interest rates have suddenly changed. Let's say interest rates have changed from 10% to 12%. Okay, interest rates have changed from 10% to 12%. So based on the same logic what I told you for fixed deposit, if there is a security which has fixed payments and the payments, coupon payments, are based on a specific fixed interest rate, suddenly the market interest rate is now changed to 12%. Market interest rate is changed to 12%. Now, and assume that this change happens immediately on the same day. Morning they issue the bonds, evening let's say interest rate has changed to 12. I am making it a very purposely a very extreme example so that I can actually explain things to you better. It usually does not happen like that. Interest rates don't change in such a short term, and also interest rates change over a longer period only. Suddenly they won't be changing from 10 to 12. But in our example, let us say morning they issued the bonds, evening interest rates have changed. Right? So 1 day is also not yet over. Okay. So now in the market, how will the bond be valued? The bond will be valued as 100 is gone. The repayment is 110. So what you will do is 110 divided by 1.12, because 1 day is also not yet over. So 110 is after 1 year the investor will get money. So 110 divided by 1.12. Why 1.12? Because the discounting rate is 12%. Why? What is 12%? The market interest rate for similar kind of bonds is 12%, or similar kind of borrowing by this company or similar kind of lending by these lenders will be 12%. So we do it as 110 by 1.12. So what happens? What is the price of the bond now? If you do 110 by 112, you will get from probably 98.2 or something like that, okay, approximately. So the price of the bond has fallen because of a rise in interest rates. So bonds price fall when market interest rates increase. This is the first statement you should remember, okay. Now, for the moment, I am calling this as market interest rate. Okay, for the moment, I am calling this as market interest rate. Okay. Now, let us say if I tell you that the price has fallen from 100 not to 98.2, but let us say 97.2. I am telling you the price has fallen from 100 to 97.2, not 98.2. Can you backwork and compute this particular interest rate in the market? What should be applicable for this kind of a bond? If I tell you the price instead of falling from 100 to 98.2 has fallen to 97.2, then what should be the interest rate? So the interest rate, let's say, comes to 13%. Now, if you know the change in price, you are able to determine the change in interest rate, correct? Now, what this whole concept of yield to maturity is, the concept is basically, if somebody is buying at 98.2 today or 97.2 revised price, if new person, whoever is buying at 97.2 and he is going to get a cash flow of 110 at the end of 1 year, at what rate should you discount based on the price already being known at which the new person is going to buy and the end cash flows that they are going to get? At what rate should you discount this end cash flows such that NPV is 0? Exactly similar to IRR concept, boss. This is 100% similar to IRR concept. Initially, you purchase now a bond for 97.2. See, what did I say? Initially, the company issued bonds. Bonds are at 100 rupees is what it took. It will repay them 100 plus 10 and all of that. Now, suddenly interest rate has changed. Interest rate has changed and now the price has fallen to 97.2. When a new investor is trying to buy from these existing investors at 97.2, when a new investor is trying to buy from these existing investors at 97.2, existing investors will make a loss because today morning they invested at 100, evening it is 97.2, so they will make 2.8 rupees loss. Ignore that. Okay, keep that aside. But the new investor who is coming in, he is getting the asset at 97.2 and at the end he is going to get 110. So what is his IRR? What is his IRR? That number is called yield to maturity. That is, what is the yield of all the cash flows that you have? Take the outflow 97.2, which is the outflow for the new investor, and the inflows, which is this 10 rupees and 100 rupees at the end of the year. If you discount all of these by one particular rate at which both of them become, the net value becomes 0, is called yield to maturity. That is all. And now, if you've understood this yield to maturity as IRR concept, you are 100% right. What you have to remember is, if you have price, you can find out yield to maturity, or if you have yield to maturity, you can find out price. If you don't know both of them, you can't find out anything. If you don't know either of them, you can't find out anything. You need price to find out YTM, or you need YTM to find out price. Correct? So far so good. Now, if you take this concept, yield to maturity concept aside and look at what we have discussed so far, if the market interest rates go up, beyond the coupon level, we said the price comes down. The market interest rates go below the coupon level, coupon is 5, market rate comes down to 2, then the price of the bond will increase. So, when the price of the bond is increasing, for a moment forget that market interest rate concept. When the price is increasing, what is the relationship with yield? Yield is decreasing. Correct? Same as market interest rate, but now I am telling you, forget the word market interest rate and think of it as YTM. When the price increases, YTM falls. When the price decreases, the price of the bond that is being traded in the market post its issue, when that particular thing decreases, it means that the yield is going up. So, the yield is directly linked to market interest rates. I am not disputing that. It is, in our example, everything is same. Okay, but please hold on. If you try to just directly correlate between the price of the bond versus the yield, the clear understanding is when yields go down, prices go up. When yields go up, prices go down. This is what you have to remember. Okay. Yield is IRR, correct? So, this is the fundamental relation that you have to understand before we do anything else in this topic. Before we do anything else in this topic, you have to understand. We've been discussing the same thing from first example, fixed deposit, then I told you this company and all of that. But you see, in fixed deposit, I was telling you that why things are happening, how the price is changing. In this example, I am telling you, I have told you the concept of what is YTM and I am telling you the relationship between YTM and the price. So, whenever someone says what is the relationship between YTM and price, it is inverse. If one goes up, other goes down. If one goes down, other goes up. Okay, this is the fundamental thing that you have to understand. Now you have, believe me, you have understood 60%. Earlier I said you have understood 50%, now you have understood 60% of this topic. Okay, you have to understand this aspect extremely clearly, because everything they will confuse you, they will use so many new terms, all fancy jargon will come in and all of that. But this relation always will fundamentally remain the same. No matter what happens in the world, okay, typically, and again, no matter what happens in the world, other than the fact that something very extraordinary happened, let us say for a bond, suddenly company is gifting extra 100 rupees, then this yield is irrelevant. Okay, let's say for a bond, company says, specially I want to give all bondholders extra 100 rupees, then obviously the yield will not follow this interest rate logic. Or the company, let's say, goes defaulting, then the yield will not follow this logic. But as long as company is in the same position and repaying the money and everything is normal and straight, this relationship between yield and price will hold. They both are inversely related. Fair enough? Now let us move to the next aspect.